Okay.
So when you compound the bets, you get 0%. When you don't compound the bets, when you make a fresh bet every single day, you get 25%. So the 25% is called the arithmetic return, and the 0% is called the geometric return. And
Okay, well, thanks for joining us today. Really appreciate your time, and especially appreciate your long threads on Twitter. And you have some very interesting stuff. And today I kind of want to dive into one of those threads that you talked about, specifically the volatility tax, or some other people call it the volatility drag on portfolios. But before we kind of jump into all that, can you maybe just give us a little background about yourself, in case people haven't found you on Twitter yet, or where they may be able to get some more information on your thoughts and concepts, basically.
right. So thank you very much for having me on. It's a pleasure to be here. So I'm a computer scientist by training. I don't have any formal background in finance or investing or anything like that. But the reason I'm here is that I help educate people about finance and investing, primarily through Twitter. So approximately once a week, I take some topic that's relevant to finance and investing, and then I write a little blurb about it, a thread about it on Twitter. And so this is how I try to educate people. And how I got here is, I think it's important for all of us, really, or most of us, to understand the fundamental concepts of finance and investing. And the reason is very simple. So if you look at the interest rates today that we are able to get from a checking or savings account or anything like that, they are super low.
Sure.
And if you look at inflation today,
Yeah.
it's creeping up on us.
Yes.
And so if you just take your money and put it in the bank, there is a good chance that that money will lose its purchasing power over time. And so the only way to build any reasonable amount of wealth to live comfortably is to learn how to invest properly.
Correct.
And so I came to this conclusion a while ago, and then I started trying to teach myself the basics of investing. And I found that there is just so much of jargon in the space, and I could not understand any of the fundamentals of finance or investing at the beginning. So, for example, Apple is trading at say $150 a share or something like that, right, today, and Google may be trading at say $2,000 a share,
Yep,
or something like that.
Yep.
So if you asked me, is Google worth whatever
$2,000.
Yeah, 2,000 divided by 150. What is that? 2,000 divided by 150. Is Google worth about 13 times as much as Apple?
Right. Okay. Gotcha.
I would have probably said, yeah, that sounds about right when I first started out. So simple things like this.
Right.
It took me an enormous amount of time to just understand the basic concepts. And so my whole mission with my Twitter account and with all the things I do trying to educate people is to help them learn the same concepts that I learned, but hopefully with far less time and effort than I had to spend to learn the same things.
Right.
So
right.
that is my mission in life. And so I started this Twitter account, and I was completely unprepared for how popular this account will become in such a short time.
Sure.
So the response that I've received from Twitter has been overwhelmingly positive.
Yes.
And I've gotten to meet so many people whom many of my heroes whom I would have never met otherwise.
Yes.
And so it's been a lot of fun.
So I imagine well, first of all, it's a very noble pursuit. So again, thanks for all the readers that follow you on Twitter. So it sounds like you kind of just started out trying to educate yourself, and you thought it a service to the community, so to say, to educate others. And unfortunately, we don't have a lot of that, right? So it's a very noble pursuit that you're kind of going down. So I appreciate that.
Well, it may have noble consequences, but there are selfish reasons behind it. So the
Well,
more I write, the more clearly I think, and so on. So it's not all selfless education
well,
or something like that. But
you're being
I'm glad
modest,
if
I
it
think.
has some
I think you're being
beneficial
modest.
side
So,
effects.
have you been approached yet to run a hedge fund or something like that? I would imagine, or that's still way off into the
Uh,
sunset at this point, you think?
Well, there have been people who have approached me trying to hire me,
Yeah,
not necessarily to run a hedge fund,
right. Gotcha.
but I have received some offers. Uh, Although I'm reasonably happy where I am.
Yeah,
Uh, as a computer scientist, I really enjoy my day job,
yeah.
um, and so I've just been doing this on the side for now.
That's great. That's great. Well, yeah, come on over if you need some. If you're looking for employment, I'm happy to employ you, sir. So,
Yeah.
um,
Thank you so
so
much.
let's let's jump into the volatility drag, or the volatility tax, as you call it. I think the first best place to kind of start is what is volatility, or at least how are you going about defining it in this space? I know, in the financial advisory world, they typically look at either beta or standard deviation, or Sortino ratio or something like that. So I just want to clear up before we kind of dive into all the math, what volatility metrics, or how you're defining volatility in this concept.
Right. That is such a great question. And when you're talking about something, it's always a good idea to try and define it as
Sure.
precisely as possible before getting
Right.
into it. Um, so the general intuition is that when a stock or an asset price moves around a lot, we call it volatile. And when the price of the asset doesn't move around a whole lot, we call it less volatile.
Yep.
Now the question is, how do we take this idea of is it moving around a lot or not? How do we take that and translate that into precise numbers? And so this is where the problem arises. So whenever you want to take a, a complicated concept like volatility and boil it down to a single number that expresses that measures this volatility, there's going to be some loss of information because it's a complicated concept. It cannot be reduced to a single number.
Metric.
Uh,
Right.
so there are ways that people have thought about it before. So if you read some of the theories of Harry Markowitz, for example, their risk is defined as some measure of standard deviation or something like that. So
Correct.
what happens is, let's say you have a stock, and the stock moves, say 1% on some days and 2% on other days, and so on. So what you do is you just take the standard deviation of all these movements. So so when let's say the percentage movement in the stock is X, the stock
Yeah.
moves X%. You treat X as though it is a random variable, and you calculate the expectation of X squared, and do expectation of X squared minus expectation of X, the whole squared, and that is the variance, and then you
Right.
take the square root of that, and that's the
That's
standard
standard
deviation.
deviation. Right.
And you get one measure for how volatile the stock is. But this is not the only way to do it, because when you have a random variable, the random variable has a certain distribution to it. And
Yep.
the standard deviation is just one number that is sort of extracted from this distribution. So that another way to do it is called mean absolute deviation. So
Okay.
instead of squaring, you just take the absolute value. And if you calculate the average of the absolute value of the deviation from the average, then you will get something called the mean absolute deviation.
Okay.
And Nassim Taleb has written some excellent. He's made an excellent YouTube video about this, where he says that if you take the standard deviation and divide it by the mean absolute deviation, that gives you an indication of how fat-tailed the distribution is. So
Okay.
standard deviation for different distributions is very different. So if you have a stock that behaves according to a normal
Normal
distribution, if
distribution.
or something like that,
Right.
then you will have a particular standard deviation. But if the stock is a more fat-tailed kind of stock, if you have a power law distribution for how it moves, then its standard deviation is likely to be much higher, and so on. So the ratio of the standard deviation to the mean absolute deviation, that is an indication of how fat-tailed the movement is. Uh, Beta is another common metric that is used, and a lot of people think of beta as representing some kind of volatility, but
Mhm.
that is not exactly correct, because beta is a sort of an amalgamated measure. It combines both volatility and correlation.
Yep.
So you can have a stock that moves around a lot every day. It could say double or halve every single day. But if all these doublings and halvings, if they happen to be completely uncorrelated with the rest of the market, then the stock's beta will be zero.
Zero.
Uh,
Right.
so,
Exactly.
so this is a very volatile stock. Most people would say this is a volatile stock, but its beta could end up being zero. And that's because beta measures a combination of not just how volatile the stock is, how much it moves around day to day, but also how
The correlation.
correlated this movement is with
Right.
the rest of the market.
Right.
So beta is not a perfect measure of volatility, but neither is standard deviation or mean absolute deviation or so on, because you're trying to condense a distribution into a single number. So
Right.
there are all these different ways of doing it, and they're different ways may be applicable, more or less applicable to different scenarios and different kinds of probability distributions and so on. So you got to pick your fighter in some sense.
So speaking of that, then you're just kind of looking when you write about it and stuff like that, is the dispersion of the return. Is that correct, roughly, between the top end and the bottom end, or the probability of it losing money and the probability of it winning money, or how are you you're not using actual standard deviation in these Twitter threads, right?
Well, so in some of the threads, I use standard deviation, but in most threads, I like to look at the entire probability distribution of
Right.
possible outcomes.
Correct.
And then I like to ask questions like, okay, given this probability distribution, what exactly is the probability that this particular stock makes money? Or what's the probability that it loses money? Or what's the probability that its return will lie between, say, 10% and 15% per year, and
Gotcha.
so on. So given a distribution, you can ask all these different questions depending on what matters most to you. So
Okay.
if your priority is not really to achieve high returns, but is to curb the downside as much as possible, then you may be more interested in just what is the probability that this particular style of investment loses money or
Right.
something like that.
Right.
So you can calculate all these things from the distribution, and they are not, if I give you the distribution, you can calculate all these things. But if I give you just the standard deviation of the distribution, that is not enough information to be able to calculate all these probabilities. So
Right.
I typically like to look at the whole distribution instead of
Right,
just
right.
the standard deviation.
So you look at the entire return distribution to kind of come up with this volatility metric, essentially.
Right.
Okay, great. So the next step then is like return, right? So maybe talk about, arithmetic return versus geometric return and how you kind of look at that. Or I guess just explain it first of all. I think some people would find that intuitive to listen to.
Right, absolutely. So the simplest way to explain this is through an example.
Yeah.
So let's say you have a very volatile stock. Let's say the stock could either double or halve every single day, right?
Okay.
So let's say the stock is at $100 today.
Yep.
What is the stock going to be at tomorrow? Well, it could double or it could halve. And let's just say both these outcomes have a 50-50 chance.
Correct.
So tomorrow, at the end of tomorrow, the stock could be at $200 if it doubled, or it could be at $50
Right.
if it halved.
Right.
And so what is the average, the expected outcome? So that would be 200 plus 50 divided by 2.
By 2,
right?
125, right.
So that is $125. So today the stock is at $100. You look at tomorrow, the expected value of the stock is $125.
Correct.
So this looks like a 25% return in one day, right?
Correct.
And this 25% is called the arithmetic return. So you take the probability distribution of all possible outcomes, and then you calculate the expectation of that probability distribution, and that gives you this arithmetic return. Okay. So if you were to take a fresh $100 every single day and put it into the stock, so some days the stock will go to 200, some days the stock will go to 50. But if you kept doing this for a long time, and if each day is independent of the previous days and so forth, on average, you will make 25% per day on your $100.
Because the doublings will kind of or offset the losses essentially in the long run.
Well, so, yes. So the doublings will, so what we are, in our experiment, what we are assuming is that you bring a fresh $100 every day.
Every day, gotcha.
And then at the end of the day, the stock could be at 200 or at 50, and then you sell the stock at the end of the day. Next day, you bring in a fresh $100, and then you again buy the stock. And then at the end of the day, you again sell the stock. So on half the days, you will make $100. Right. On the other half of the days, you will lose $50. Right. And if you put these two outcomes together, you will make roughly 25%. You'll make $25 each day. And so that is an arithmetic return.
Okay.
But this is if you bring in a fresh $100 every day and put it into the stock. What happens if you just put in the $100 at the beginning and then just leave it in the stock? Don't take it out. Don't sell it and buy it back the next day and so on. Just leave it in the stock day after day after day.
Right.
Then something very interesting happens. So what's going to happen is on some days, the stock is going to double. And on other days, the stock is going to halve. And if the proportion of doublings and halvings remains 50-50, then all these doublings, they will cancel out all the halvings.
Yes.
And so doubling means your money gets multiplied by 2. Halving means your money gets divided by 2. Yep. Multiplication by 2 and a division by 2 cancel out each other. Yep. So if you just left your $100 in the stock without selling it at the end of each day and bringing in a fresh $100, if you just let these individual bets compound over time, then what happens is the most likely outcome is that you will be left with exactly the same $100 that you started with. So your return is 0%. The most likely return that you will get is 0%. So when you compound the bets, you get 0%. When you don't compound the bets, when you make a fresh bet every single day, you get 25%. So the 25% is called the arithmetic return, and the 0% is called the geometric return. And the geometric return is usually much less than the arithmetic return if your stock is a very volatile stock.
Okay. So that's how volatility kind of plays into this. So you say, if it's super volatile in the long run, your geometric return is going to basically decline over time versus the arithmetic return, which stays even the entire time based on expected return, essentially.
Yes, I think that is a fair characterization. So yes, if you let your bets compound and your stock is a very volatile kind of stock, then your geometric return will be much less than your arithmetic return if you wait long enough.
So in your example, we showed that basically your return ends up at 0. You end up at $100, even though I started with $100. Is there a formula to tell me, like, this is if a stock exhibits X amount of volatility, then if you hold it for 20 years and it continues with that same volatility, I'll end up at the same spot? Or is this kind of randomness? I know volatility changes over time, so it's hard to kind of estimate that going into the future, but I'm wondering if there's any type of I guess formula or something that you've looked at that says if a stock exhibits 20% standard deviation, I can expect a 0% geometric return if I hold it for 50 years or something like that.
Right. So there is a formula, but it's not just dependent on the standard deviation, because it depends on the whole distribution, not just the standard deviation.
Okay.
So if you take the entire distribution of outcomes, so in this case, for example, we have just two outcomes.
Yep.
So the formula is the return you get in outcome one raised to the power of the probability of outcome one,
Okay.
multiplied by the return you get from outcome two raised
The power,
to the power of the
probability.
probability of outcome two. So in this case, outcome one is a 2. Because you could double your money.
Yep.
Outcome two is half.
Right. 0.5.
Yeah, exactly.
Yeah,
0.5, because you could lose your money. So
right.
Over a long period of time, you take and both outcomes have probability of half.
50%.
Yeah, 50%.
Right.
So you take 2, raise it to the power half, and then you take half and then raise it to the power half, and then multiply the 2 together. You will get exactly 1, which is a return of 0%. So
right.
you start with 100, you end up with just 100 multiplied by 1, which is 100. So that is a return of 0%. So in general, there is a formula for just as there is a formula for calculating the arithmetic expectation of a random variable, the expected value of a random variable, that there is a similar formula for calculating the geometric expectation. But here, what you have to do is you have to raise the outcomes to the power of the probabilities.
Gotcha.
With the arithmetic expectation, you just multiply each outcome by its corresponding probability and add them all up.
Right.
Here you have to do some power raising to the power of the probabilities and so on. So that is the formula.
So I think advisors listening to this, or investors in general, would then make the next question of, well, should I just stay away from volatile assets then? Because if my long run return converges on 0, essentially, if it's highly volatile, what's the actual point of investing in volatile asset classes, as opposed to something that is more of a low volatility, consistent type of performer? Do you have any thoughts and any suggestions on that, basically?
Right, exactly. So this is a great question. So it is true that if you have 2 different assets and they both have the exact same arithmetic return, but one of the assets is more volatile than the other, then the geometric return of the more volatile asset will be lower. But there is, if you're a fundamentals driven investor, then you believe to some extent that over a long period of time, the price of a stock is going to follow the fundamentals of the company. So the fundamentals could be revenues or earnings or cash flows or book value or whatever your favorite metric for the fundamentals is. So over a long period of time, you believe that even if the stock is volatile in the short term, as long as the fundamentals remain good, the growth of the stock is going to follow the improvement in the fundamentals over time, right?
Okay.
So this seems almost like a contradiction, because
right.
we said that a more volatile stock is going to give you a lower return.
Right.
But now we are saying that volatility doesn't play as much a role in the long term as the fundamentals. So now, which is more important? Is it the fundamentals or is it the volatility, right?
Right.
So there are some assumptions that we made in our volatility calculation, which is we assumed that each day is independent of all the previous days. For example, Correct. We said the stock could double some days and halve other days, and it's completely independent of what happened the previous set of days. But in the real world, let's say a stock keeps going down for say 4 years in a row. Okay. Yep. But the fundamentals of the company have been improving. So this happened with Microsoft, for example. So towards the end of the dot-com bubble, what happened was after the bubble burst, Microsoft was already at a very high valuation at the time of the bubble. And then after the bubble burst, the stock went nowhere for many years.
Yes.
But the company itself was improving all the time. The revenues were growing, profits were growing, cash flows were growing. All the numbers were looking great, but the stock was going nowhere. So over a long period of time, at some point, that has to end. Or if you're a value investor, you believe that the stock will ultimately track the fundamentals. So if the stock has been going nowhere for a while, but the fundamentals have been improving for a long time, then sooner or later, this independence assumption that what the stock does this year is completely independent of what it did last year, that assumption will break down, because over a long period of time, the stock has to track the fundamentals.
The fundamentals, because the earnings are coming in, the profits are coming in, et cetera,
Right.
et cetera. It can't keep just going to zero or whatever it is.
Right, exactly. So then,
also, go ahead.
You have to care not so much about the day-to-day volatility in the price of the stock, but you have to care about the volatility in the fundamentals themselves.
Gotcha.
So if the earnings grow, say 10% in some years, and then they don't grow at all in other years,
right?
And that is a 50-50 random variable, whether earnings grow 10% or not at all.
Yes.
Then over a long period of time, the arithmetic average may be 5%, but you will get less than 5% from the stock, because now you're caring about the volatility, not in the price of the stock, but in the fundamentals. And if you believe that the stock price will track the fundamentals over time, then it stands to reason that you should care more about the volatility in the fundamentals.
Right. The underlying thing that, stocks are based off of, the future cash flows and stuff like that, basically. Right?
Exactly.
So at some point it catches up and says, okay, well, the stock has to now revert positive because the earnings have been positive for the last 10 years. But what you're saying is, if earnings or whatever fundamental metric, your ROI or whatever you're following is also highly volatile, then that's where the volatility drag then becomes a bigger factor in the overall return that you're going to get. Is that correct?
Yes, absolutely. So if you take a commodity company, for example, if you take a company that sells sugar or oil or something like that, and their returns are very strongly dependent on the price of a commodity, which they don't control and which is highly volatile for some reason.
Right.
Then you can be reasonably sure that over a long period of time, the performance of this stock is going to depend on the price of this commodity. And the price of the commodity is very volatile. And so you will end up with exactly this kind of result, where your geometric, if you just leave your money in the stock for a long period of time, then the geometric return you get will be much less than the arithmetic return, and so on.
Right. So I guess there's kind of two questions that come to mind. If you don't have an underlying assumption of fundamentals, right? So some people, the efficient market hypothesis, right? Like earnings will grow in the long run as long as the economy is growing, et cetera, et cetera. If you're not taking a view on that, then it does matter on the volatility side, then, which stocks or which investments I want to put into the portfolio. Would you say that or no?
So let me clarify the question. So are you saying if you believe in the efficient market hypothesis, then how would you invest your money?
Correct.
So if you believe that prices at any time in the market, they reflect all available information. And then whatever information comes in the future is essentially random. So it could have equal, it could push the stock up, but it could also push the stock down to roughly the same extent. Then you're essentially believing in this kind of independence assumption, where you're saying the price of the stock will go up and down
Independently.
pretty much independently of what it did the previous day, just based on whatever new information happens to be coming in. And if you believe that the new information is more likely to be positive than negative, because the economy grows over time,
Right,
and
exactly, right.
productivity improves, and all there are all these factors. So if you believe that the new information, which is going to be reflected in the prices very soon, uh, if you believe that this new information has more of a chance of being positive than negative, then yes, you will suffer from the volatility of this new information, because some days it's going to be positive, other days it's going to be negative. But over a long period of time, you will get the geometric return, and
Right.
if your beliefs about the efficient markets hypothesis are correct, then this is exactly the geometric return is exactly what you will expect to see uh, over time if you just leave your money in the stock.
Okay.
But you don't have to leave your money in the stock. So, for example, if a stock doubles or halves every single day, uh, we said that the geometric return is zero, but the arithmetic return is 25% per day.
Right. Right.
Now there is a way that you don't have to settle for zero. And that way is to rebalance your portfolio.
Okay.
So what you do is you have 50% of your portfolio in cash at all times,
Okay.
and you have 50% of your portfolio in the stock.
Okay.
So let's say you start with $100. So you put $50 into the stock, and you put $50. You just keep it as cash.
Right.
So if the stock doubles, what's going to happen is this 50 that you put in the stock is going to become 100.
Yep.
The other 50 is going to remain exactly at 50. And so now you have $150.
Right.
So now what you do is you sell part of your stock to bring it back to the 50-50 mix. So you have a portfolio that's worth $150. You sell a little bit of stock, so that now you have $75 of cash and $75 in the stock.
Right.
And next day, if the stock falls down, then what you do is you take some of your cash and put it into the stock. So you keep rebalancing every single day in such a way that at the end of the day, you're always 50% in cash and 50% in the stock.
Okay.
It turns out that if you do this kind of rebalancing on a daily basis, then if your stock follows this particular distribution of doubling or halving every single day, then you can actually make over the long term 6% per day, roughly.
Okay.
So you don't have to settle for 0%. You
Okay.
can apply a rebalancing technique and get 6% per day. So there are ways you can if your stock is truly volatile, you can take advantage of the volatility by making this kind of rebalancing driven bet every single day.
I wonder how that comes into play with like the momentum theory, right? Like what we're assuming is like each day is independent of the previous day, right? But there is this factor that a lot of people follow and have written about of momentum. So how does that play into it? Like, does that help me or hurt me if I believe in momentum, that, you know, if a stock's going up, it's going to continue to go up until it hits some turning point. And then if it's going to go down, it's going to continue to go down. Is there any, I guess, math, so to say, behind it as to how that affects your geometric return and everything?
Absolutely. So that's a great question. So with momentum, essentially what you're believing in is that the independence assumption is flawed.
Right.
So what we said is that if you assume that the stock either doubles or halves every single day, and the stock is completely, the movement today is completely independent of what happened yesterday,
right,
then this particular rebalancing strategy helps you get your 6%.
Okay.
But what if it's not independent? So what if on a day that the stock goes up, suppose the stock went up today, then tomorrow there is an 80% chance that the stock will go up and a 20% chance the stock will come down. So up days are more likely to be followed by up days than down days. So there is a theory around this, and the way it is usually modeled is to use a Markov chain. there are these mathematical objects called Markov chains, and what you do is the Markov chain could have a certain number of states, and you say, okay, what state am I in today? That affects the probability that my stock will go up or down today.
Right.
So today, if the stock goes up, then I'm sort of in the up state, and so there's an 80% chance that an up state will be followed by another up state.
Upstate, right.
But there's a 20% chance that I could move from an up state to the down state.
Correct.
And then once I move to the down state, now the probabilities are different. Maybe now the probability is that there's a 70% chance of a down state being followed by a down state. So
Right.
now we have a more complicated model than the independent model.
Right.
And now we have to figure out at each individual state, how much of our bankroll do we want to bet on the stock, and how much do we want to keep in cash?
Right.
And what is the optimal way to do that if we know the probabilities and so on? So
we
you
have to
can get as
know
complicated as you
we
like.
have to know the probabilities, though, basically at that point, essentially, correct? Like,
yes, you either have to know the probabilities precisely, or you have to have some idea of the probabilities.
Okay, so that's great. I'm wondering also how the geometric return changes if I'm adding money to a portfolio. So like what we've kind of talked about now is like a lump sum and then just let it ride and see what happens in this independent state. But now most savers, investors are continually adding money. And then on the flip side, retirees are taking money out of this thing, right? So does the volatility of the assets that they're investing in, is it more favorable to invest in volatility on the front side and then lower volatility on the backside when you're taking money out? Or is there any type of math that you've looked at that kind of explains, hey, this is the most favorable way to do it when you're putting money in, and the most favorable way when you're pulling money out?
Right. So that is a great question, and there is a whole sort of kind of risk called sequence risk.
Yes.
That comes into play when you're adding money into a portfolio or removing money from a portfolio. So if you just with no addition or removal of capital from the portfolio, if you just take $100 and leave it in the stock, we said that if you have, say, 50 doubles and 50 halves over 100 days, all those doubles and halves are going to cancel each other out, and you'll be left with exactly the same $100 that you started with.
Correct.
But if you're continuously adding money to the portfolio, then the order of the days makes a big difference. So if you didn't add any money to the portfolio, then you don't care whether an up day is followed by a down day. You don't care which order the 50 ups and 50 downs appear in. They could appear in any order.
Correct.
Doesn't matter. You'll still be left with exactly the same $100 that you started out with.
Right.
But if you're adding money every single day, then what you should hope for is that all the down days come first.
Okay.
And then they are followed by all the up days. Because if you have so one way to think about it is you're continuously adding money into the portfolio, and so you are going to be betting larger and larger sums of capital as you go more and more into the future. Your portfolio size is going to keep increasing simply because you're adding money to the portfolio.
Correct.
And so if you had to experience a 50% drawdown, you would much rather experience the drawdown at the very beginning when you don't have a whole lot at stake than at the end when you have a lot of money at stake.
Because
so
it's
people
been
who are
that entire time, basically, you're
exactly
right. Yeah. Okay.
Exactly. So people who are saving money, they should hope for down days to come early on.
Right.
So people who sort of just got started during the 2008-2009 downturn or something like that, they are the most advantaged savers because they could put money into the market when the market was down, and then if the market kept going up, So if the down days come first and then they are followed by up days, you tend to do better if you're continuously adding to the portfolio.
Correct.
Now, the exact opposite of that is true if you're continuously removing money from the portfolio.
Right.
So if you're a retiree, you're planning to retire this year, you should hope that the market doesn't go down this year. Because
Right.
if the market goes down this year, now is when you have the maximum amount of capital and you will lose a lot. Whereas 10 years later, you've already drawn down a portion of your portfolio, and
Right.
you care a little bit less if the market goes down at that time. So there are some simulations I've done where there is, for example, the famous 4% rule for
Yes.
retirement.
Yes.
So essentially, the 4% rule is if you need, say, if you for every $1 that you need in retirement in annual expenses, if your annual expenses are $1, you need to save up $25. Your portfolio has to be worth $25, and that's because the $1 is 4% of $25.
Correct.
So whatever you think your annual expenses are going to be in retirement, your portfolio has to be 25 times your annual expenses. That's the 4% rule.
Correct.
Now, I went back and looked at history to find out under what conditions the 4% rule has actually worked, and under what conditions, even if you follow the 4% rule, you would run out of money.
Okay.
And usually, the way to run out of money is to have a big market crash
at the front
in the year that you retire or immediately after you retire.
Right.
So then what happens is you momentarily go over the 4%, because if there's a big market crash, you will tend to withdraw more than 4% of the portfolio.
Correct.
And then that is going to set you into a downward spiral, and there is a chance that you will lose money.
Right.
So if you're removing money from the portfolio, you should hope for the down years to come later.
Right. So in your analysis, I'm interested. I actually wrote a paper, A Sequence of Returns Risk, right? And
absolutely,
kind of retirement. I know advisors, and the 4% rule was, I guess, discovered, you could say, by Bill Begnan, I believe is his name, or William Begnan. But he was an advisor back in this, I think he wrote the paper in the 80s or 70s or something like that. And I know a couple of people like Morningstar's run some of the simulations to try and figure that out. Did you find, so some of his assumptions were, look, you're gonna live for 30 years. So back then that was a long retirement time frame, right? Nowadays, people might be living 35, 40 years. But I'm just interested in the data that you came up with. Is 4%, in your opinion, or the simulations you ran, still a fairly conservative number for to last out? Or I know the Morningstar one had shown it still kind of worked, but based on where valuations were at the time they wrote the paper, they were like, it's probably not going to work going forward, right? But just kind of curious as to what you found in your data set when you ran it.
So if you have, so in my data set, the simulation that I ran assumed that you have 25 times your annual expenses, but you put it in an all stock portfolio.
Okay.
Now, a lot of retirees don't do that. So
right.
when they retire, a significant part of their portfolio actually contains bonds and
Correct.
not stocks.
Right.
And if you assume that over a long period of time, bonds will underperform stocks, then the results are even worse than my simulation. So in my simulation, I found that even if you had an all stock portfolio, there's a decent chance, not a very big chance, but that I found going back over, I think more than 100 years, that there were about 13 cases or something like that where you would run out of money.
Okay.
If you followed the 4% rule, and if your annual expenses sort of kept pace with inflation. Now that there are, so in retirement, many people find that their annual expenses don't go up as much. because they tend to go out less, they tend to take fewer vacations, they tend to commute less, and so on. So typically in retirement, your expenses tend to be a bit lower.
Yep.
But then you also have to spend more on healthcare and things like that. So there
Correct.
is a balance there. But what I found is that out of about 100 cases or something like that, I found 13 cases or something where you would run out of money. Now, I am a very conservative person. So each person has to sort of decide for themselves. So if I follow the 4% rule, if there's say a 13% chance that I will run out of money in retirement, are you willing to take that chance or not? Now, I am not willing personally to take a 13%
Chance
to
that you run
risk
out.
that there's a 13% chance of running out of money, because the idea of financial freedom, financial security is sort of very important to me.
Okay.
So I would much rather go for something like a 2% rule, for example, 2% or even 1%. But of course, that means you would have to save
100x your capital or your annual expense then.
That is a big ask
Right.
for a lot of people. But it really depends on how conservative you are.
Right.
And so I am personally very conservative. So I like to be as safe as possible. And I really don't want to run out of money in retirement.
Right. Absolutely. I mean, that's the major fear for most people, right? Because you have no
Right.
human capital at that point to go back to work if you run out of
Right.
capital, right?
Exactly.
So yeah, and I think the original paper, he did a 50-50 rebalance at the end of every year. He was 50% equity, 50% fixed income or bonds. And then he did a rebalance every year to calculate. That's how he got to the 4% number, basically.
Right.
But I appreciate that.
So it also depends on what bond yields
yes,
are.
correct. Right. Exactly.
So at the moment, they are pretty low. And
yes.
it also depends on what bond yields are in comparison to inflation, because
Yes.
you don't care very much if bonds are yielding 2% in a 0% inflation environment. You're still, the purchasing power of your money is still intact. But if I tell you that bonds are yielding 2% in a 10% inflation environment, then suddenly you care a lot because you're losing purchasing power over time and so on.
Right. Absolutely. Yeah, fair point. So lastly, kind of just getting back to the volatility drag, for advisors or investors in general, how should they think about incorporating this concept into the way they're investing, or whether it's like picking stocks or mutual funds or ETFs? Is there kind of a through line, so to say, from this concept of volatility drag to portfolio construction or asset allocation that you would recommend or talk about?
Absolutely. So there was this guy called Harry Brown who did a lot of work in this area. He had something called a permanent portfolio.
Okay,
and he's actually written a book as well. And so the idea behind a permanent portfolio is you could have two different kinds of things happening with the economy. So the economy could be expanding, or the economy could be in a recession and so contracting.
Yeah.
And you could have two different things happening with the currency. The currency could be inflating or deflating. There could be an inflationary environment or a deflationary environment.
Okay.
So what Harry Brown said is, under all these different circumstances, you should always have some part of your portfolio that is doing well, and there will be other parts of your portfolio that are not doing well. And what you do is you have to, so there are two main characteristics to a permanent portfolio. So the first characteristic is it should be diversified. So you should have some assets that are doing well if you enter a deflationary environment. You should have other assets that are doing well in an inflationary environment. So you should have both kinds of assets in your portfolio, because there's no, you're starting from a place where you don't have information about the future. So you cannot predict what's going to happen in the future.
Right.
So if you cannot predict, you have to be prepared for all things that could possibly happen.
Correct.
Or as many things as could possibly happen. And so so the first thing is diversification. You have to be diversified as far as possible. The second thing is a rebalancing. So every year or something like that, there are assets in your portfolio that have gone up, and there are other assets that have gone down, following the economy, following inflation or deflation, and so on. So what Harry Brown said is you have to rebalance the portfolio periodically, so that you get back to that base allocation that you have. And there are lots of people who have taken Harry Brown's ideas and extended them further, and so on. There's Meb Faber, for example. He's got a portfolio. There's a Ray Dalio who has an all-weather portfolio.
Right. Correct.
And there's my friends Taylor Pearson and Jason Buck. They run a fund called the Mutiny Fund. They have a portfolio called the Cockroach
Fund
portfolio.
Or a portfolio.
Yeah.
Yes.
So there are all these people who've taken Harry Brown's ideas and sort of extended them and implemented them in slightly different ways, and so on. But I think in general, it's good to be worried about volatility, and it's good to, if you're a fund manager, it's good to prepare your clients for volatility by having a range of different assets, making sure the clients are properly diversified at all times. And that to maintain that level of proper diversification may require rebalancing on a regular basis. So that is one way fund managers can help their clients navigate volatility. The other way is to not turn short-term volatility into long-term risk. I see so many fund managers and so many individual investors. They put themselves at long-term risk. So because of short-term volatility. So if you take a margin loan to buy a stock or something like that, or if you're highly leveraged, then a short-term blip in the markets could end up killing you because you get margin called. So you have no control over the day-to-day short-term volatility in the markets. So why would you let short-term volatility become a long-term risk? It makes no sense. So if you're ever in a situation where something that happens in the short term that's completely outside your control could end up wiping out your portfolio or something like that, just as far as possible, try not to take any of those risks.
Gotcha.
Try not to leverage your clients' portfolios for an extra couple percentage points of return and things like that. And also make sure that the clients are psychologically able to handle a downturn. So this is a very underappreciated part of fund management. So fund management is as much a relationship business as it is a performance-driven business. So there's so much of focus on how have I done versus the market and so on. There's so much focus on performance. But at the end of the day, what clients typically want is they don't want the highest possible performance. They just want good enough performance, but complete assurance that their money is in good hands and so on. So if the markets are down, or if there's a recession or something like that, that is when clients tend to panic a lot. That's when funds tend to face a lot of redemptions and so on. So I think a fund manager's responsibility is they have to be proactive in educating their clients and preparing their clients for such eventualities. And then holding their clients' hands and essentially just helping them weather the volatility and helping them keep their temperament and peace of mind. That is an underrated aspect of fund management.
Yeah, it's almost like you're a psychologist, really, when you're talking with clients in these type of environments.
Exactly.
I think Morgan Housel put it best on one of his podcasts that I listened to, is like, volatility is the price of admission to the long-term return, right? So you have to be able to pay that volatility admission if you want that long return. But the issue is that short-term thinking, recency bias, all of that stuff kind of comes into play at that point in time, and clients are more apt to get out than wanting to stick through it, basically, so that's a great overview, 10K. I really appreciate it. Before I let you go, a couple kind of final questions I always ask my guests. The first one is, do you have like a mentor or some type of book or some type of investment theory that kind of colors the way you look at investments in general? Or to me, it seems like you're a blank slate, but a lot of people, came into the business under some tutelage or some mentor. But I'm wondering if you read a book or something that kind of skew is a bad word because it makes it sound negative, but I'm saying like kind of colors the way you look at investing in general.
Right. There are several investing books that have sort of shaped my thinking. So I started out with reading Roger Lowenstein's biography of Warren Buffett,
Okay.
and so I dug into Warren Buffett a little bit more, and I, I've read all his shareholder letters, and they have
Yeah.
made a big impression on me. So I don't have formal training in finance or investing.
Right.
So most of the things that I learned about investing, my worldview about investing, have come from reading Warren Buffett's letters to Berkshire shareholders.
Okay.
So there's a very nice book that by Max Olson, I think that compiles all these letters into a single book.
Yeah.
And so you can get that book and read it, or you can just go to Berkshire's website where
Yeah,
all the
download.
letters are available for,
Yeah.
well, I think the letters starting from 1977 are available. So there were a bunch of earlier letters starting at 1965 that are not available on the website. So for that, you may have to get this
book.
Olson book.
Yeah.
But you can get Buffett really got into his stride in the 70s and 80s writing letters. So I don't think you miss a whole lot but by just reading the free letters on his website.
Right.
Yeah. So that has definitely those letters have definitely shaped the way I think about investing.
Okay.
Then there's Michael Mauboussin.
Yes.
So I haven't read everything that Michael Mauboussin has written, but every single thing that I have read, for example, his recent book, Expectations Investing.
Yes.
It's just Professor Mauboussin is pretty much on the dot on most things that he writes. Have made me think about investing in new ways. So if someone wants to learn the fundamentals of investing, I would recommend them to read Michael Mauboussin.
Yes.
Then there is Aswath Damodaran. He does great work.
Yes.
His YouTube videos are great, and from time to time he shares his valuation models. So if you're interested in learning how to value a company and so on, his spreadsheets are a great place to start to try and figure out some of the fundamental concepts here. Then there's Howard Marks. Howard Marks has written some beautiful memos covering the basics of economics and so on. There's Poor Charlie's Almanac, another wonderful book about Charlie Munger and the way he thinks about investing and other things.
You've read them all, it sounds like, basically. Yeah.
Well, I try to follow my curiosity.
Yeah, I actually took Damodaran's NYU valuation class. And I'm in amazement with that professor, because he puts everything out there. Like you go to his website, you can download his models. He puts all of his, earnings expectations and all of this great data sets. I think he's a phenomenal resource as well to the investment.
Absolutely. He's an inspiration.
Yeah.
So if you're an educator in the space of finance and investing, like I am, he is a major inspiration to me. I've learned so much just by watching his YouTube videos and just by playing around with his spreadsheets.
Yeah, he's a great resource. I mean, I watch his videos as well, and that it's like you're sitting in his class essentially, right? Watching those videos. So it's absolutely a great resource. The second question I had for you is in general, I know you have the Twitter feed. Is there anywhere else that you're kind of broadcasting your threads or your thoughts or something like that, where people that are listening to the vlog can find you?
Well, at the moment, it's just Twitter.
Okay.
But I am planning to try and get outside Twitter a little bit, because again, it's a basic principle of diversification. You don't want all your eggs in one basket, but I haven't gotten around to it yet.
So
I should probably do that.
TikTok is next for 10K. Is that what it is then?
I'm sorry.
TikTok, you're gonna jump on TikTok and do something?
Well, uh, I don't know. I mean, they say that that the Chinese government has control over all your data and things like
Yeah.
that. So
Yeah. Right.
who
Right.
who knows?
Right.
It would be interesting to me to explore video as a format, at least. So I think more and more people are learning through audio and video more than reading stuff. So if you're an educator and your audience is moving towards audio and video content,
Yeah, that's what you
you
gotta
kind
go
of have to
Yeah.
move there as well.
You
So
have a
yeah, it's
podcast though, don't you? Or do you do because I listened to that one with Chris. I can't
right,
remember. It was at Callan or something like that. But how can
right.
people get to your? And it seemed like it was like a live type of thing. So is that just on your Twitter feed that people can jump in via some type of link, or how do they get to those podcasts that you've done with different, I guess, interviewees, basically?
So I've interviewed a bunch of people, and we have a bunch of episodes up. I think you need the call-in app
Okay. All right.
on your phone to be able to participate in these kinds of live discussions.
Okay.
Although I am trying to move to a more open format where people can join with even without downloading any specific app.
Right.
I don't know how that is going to work, but at the moment, I have this podcast on Callin. And I think if you want to just listen to past episodes, you don't really want to participate in the discussion or anything like
Yes.
that. I
Right.
think you can do that from just your browser.
Okay.
You can just go to callin.com. And the name of the show is Money Concepts.
Money
And
concepts. Yep.
yeah, so yeah, if people are interested, they can go and listen to past episodes there. I'm trying to move to a more open platform. Let's see how it goes.
Okay. Well, I wish you the best of luck, and I look forward to hearing those and listening to more of those great Twitter feeds. You're a coffee drinker, I take it, or no? You just
Oh
start like
yeah,
starting
big
off.
time.
Yeah, just starting off like grab your cup of coffee. I love that.
Right, exactly. It's what I do every time I write a thread.
Well, thanks again for coming on the vlog for us. 10K. We'll get this out to the public because I think it's a lot of great information you shared with us today. And best of luck with the rest of the summer for you.
Thank you so much. I really appreciate it. Thank you for having me on.
Oh, absolutely. Anytime. You're welcome back anytime for sure.
Thanks.